Hi everyone, afternoon. My name is Amelia Tan. I'm from the SGX research team. Short answer, is the Singapore market still relevant for you amidst such times? The answer is yes. Okay, that's it. We can go home already. No, just kidding. Okay, I'll spend the next 20 minutes to give some updates on the Singapore market. We just nice reached the half-year mark. We've ended the first half of the year. Very strong performance. I'm sure you guys have seen in this week alone, right? And then I guess the next question would be going into the second half of the year. What's next? What are some of the trends that we are seeing potentially from your end, my end? What are some opportunities? And today also, of course, it's ETF Festival. So we will be linking that to quite a number of our ETFs that are listed in Singapore. And we also have a booth at the next hall. Do check us out if you have not. We'll be happy to chat more with you. All right? So maybe let's move on to the next. I'm going to put this here. Okay, next slide. This is a standard disclaimer slide. Point over here is that whatever you see in terms of past performance does not guarantee future performance. Some examples I have here, illustrative only. This is meant to be more educational and sharing. So all of us, before we do our investments, of course, we also have to do our due diligence and our homework. All right, this week, what you guys might have seen is a very, very big milestone for the Singapore market. What happened to the STI? We finally crossed the $4,000 levels, 4,000 points, right, that level. The last time STI touched this, we touched a little bit at the end of March, and then it went back down again. But we finally exceeded that, and STI has actually been very, very strong. Performance has actually rallied. In fact, across 2024, you guys might have noted, STI was up 24% on a total return basis. All right, the last 12 months, STI has recorded a strong rally, and we've broken past the 17-year high, all-time high for the Straits Times Index. So it's a big milestone for us, for Singapore market. What has also happened is that it's not just for a single year, it's not just for 2024, not just for the last 12 months. The STI has consistently recorded these returns since the end of 2019 all the way until now. From end of 2019 until now, that's a good 4.5, 5 plus years. STI's annualized total return has been over 8%. In fact, 8.4%. And this has been, you see, if we plot that against some of the regional markets, ASEAN markets, Asia ex-Japan, and also Asia Pacific, we have actually outperformed these markets across the last 5 years. So that's consistently 8.4% on a total return basis over the last 5 years. From a dividend yield standpoint, we have the STI paying a dividend yield of about 5.1%. That has consistently been one of the highest dividend yielding index across other markets. Definitely against some of the other developed markets like US, so on and so forth, and even some of the regional markets over here. And in fact, when we take a look within the STI, some of the top 5 performers across the 12-month period have returned 50 to 90% total returns. How often do you have blue chip stocks returning over the last 1 year 50 to 90% total returns? But of course, a lot of our companies are also undergoing some of the strategic transformation initiatives at their end. We have a few of these STI companies that are undergoing that kind of strategic reset and creating more value to unlock to return to shareholders, which we will talk a little bit more later on. But I'll point you guys to the chart at the bottom. The dark blue line is the STI index. The light blue line is the Bloomberg 12 months consensus target price. So what analysts are estimating the STI will be within the next 12 months. So you can see that the expectations have also been trending upwards. And in the recent 12 months or so, you find that our performance of the STI and the ASEAN performance has also diverged, meaning to say that the Singapore market has actually outperformed regional peers. And when you talk to some of the market analysts, broker analysts, investors, institutional investors even, they have actually observed that the Singapore market tends to outperform during a bear market. And perhaps that's a reason why we're seeing more inflows into the Singapore market. During periods of outperformance of the STI, we have actually recorded net institutional fund inflows coming into the market. So that's what we have seen. Although, despite the rally, STI has been very strong over the last 12 months, 5 years. From a valuation standpoint, the Straits Times Index trades at a price-to-book ratio of 1.3 times. This is actually still on the lower end, undemanding, because when you look at the last high for STI, which is around 2007, the price-to-book back then was 2.5%. Today, it's still only at 1.3%. So from a valuation standpoint, it is actually trading at undemanding valuations. Now, let's also take a look at what the sectors within the Singapore market have performed. So for this slide, the numbers that I've taken a look at is based on net institutional inflows against the full market cap of each individual sector. I'll walk you through. When we look at institutional fund flows, normally we look at the total buys of institutional investors minus the total sales. So that means that if institutional investors are buying more than they're selling, net, it's a net inflow. On the other hand, if institutional investors are selling more than what they're buying, that's what we typically call as net selling. So when we plotted our entire market in terms of what institutional fund flows are looking at, generally this is a trend. The first chart on the top shows the first half of this year. Second chart at the bottom shows the total combined fund flows for the entire 2024. So across the board, 3 sectors have led the institutional inflows. That is energy, telcos, and utilities. For energy, it's been very strong. Turnover has also been very, very strong. Fund flows have been very strong in this sector. And the reason for that is because of the geopolitical tensions that has driven a lot of the oil stocks that we have seen. So we also have some oil stocks like Rex International, Geoenergy. A lot of these stocks have run up quite a fair bit because of that particular theme. The second one, telcos. Singtel is a big player in this space when we look at our telco sector. Singtel has been leading net institutional inflows for the last 1.5 years, and that has been what has been driving this, which I will talk a little bit about what Singtel has been doing for our shareholders also. What is interesting is when we look at the industrial sector, which is right in the middle of the chart. Last year, industrial sector net insti inflows over market cap is at 0.1%. This year, it has gone up 4x to about 0.4%. It's worth noting over here that it's not just institutional inflows that are coming big into the industrial stocks. The trading turnover has also almost doubled year on year. Industrial stocks are generally starting to gain a little bit more attention from investors. Right? And the last one, what's interesting to also note is, look at financial services, the banks. Last year, big inflows, 2.9%. Sorry, not 2.9%. Last year was big inflows of 0.4%. This year, outflows are larger, much larger at negative 0.8%. On the flip side, REITs, last year and this year, negative, meaning more institutional fund outflows. But from a number standpoint, it's gotten lesser. So what we have actually noted from the fund flow trends is that we're starting to see institutional investors rotating out of banks and going into REITs. So reversing that entire trend of buy banks, sell REITs, which is what we keep hearing for the last 2-3 years when interest rates were on a high. Because, of course, banks have been a big beneficiary of interest rates, so they have been picking up along the way. And REITs, on the other hand, have been affected because of higher interest rates. But we are now starting to see a reversion of that, partly also because from a valuation standpoint, the banks are trading at high valuations compared to REITs, which I will also talk a little bit more about it in the next 1-2 slides. Okay, now we talk about Singtel again. Singtel is a key mover for us in the Singapore market, in the Straits Times Index. A few reasons why. Just now I mentioned, Singtel has been the most, or the stock that has recorded the largest amount of institutional net inflows. Last year, till now, 1.5 years, Singtel has recorded over 1.5 billion of net insti inflows coming into this particular stock. From a price performance, stock performance standpoint, you look at the chart. From end of 2020 until now, Singtel's price doubled, right? What has happened over here? Singtel has actually been embarking on a strategic initiative, 2 milestones for them, 2021 and also 2024. 2021, they announced a capital recycling initiative, which was they targeted to divest certain assets and monetize close to about $8 billion worth, which will then go into funding new initiatives, paring down certain debts that they have, and of course, returning to shareholders as dividends. Last year, 2024, Singtel has also announced a Singtel 28 strategy, which is another capital recycling initiative, which this time they want to unlock 6 billion, which is what they announced last year. But 2 months ago, they raised this 6 billion to 9 billion. So they want to further monetize 9 billion out of the divestments to raise more funds, and again, that will go into funding new growth initiatives, and also, of course, potentially shareholders can expect more dividend payouts as they return and create value for unit holders. And because of that, Singtel has been one of the best performing STI stocks, not just in the Singapore market, right? There is actually this Dow Jones Sector Titans Telco Index, and Singtel has been the second best performer in this particular index. Singtel has also increased its STI weight, used to be at about 6% in the STI, now Singtel is at about 7.5%. So it's an interesting story over here. But Singtel is not the only STI stock that has been undergoing this kind of value unlock, creating more value for shareholders. Across the index, we actually have 6 stocks that are embarking on this. Singtel's one of them. ST Engineering, you guys might have also heard. Those are some examples. Hong Kong Land, so on and so forth. Sembcorp Industries, these are examples of companies that are doing more to create value for shareholders. And perhaps a reason why some of these stocks are also the best performers so far, returning 50% to over 90% in the last 12 months. So very, very impressive returns. Next, industrials is another segment. Why do I want to talk about industrials? It's a segment that's very important for the Singapore market, given that industrials is one of our largest sector. We got over 140 stocks in this sector. In the STI, out of the 30 companies, 1 in 4 belong to the industrial sector. And if you look at Singapore's broader economy also, 20% or more than 20% of our GDP comes from the manufacturing sector. So as we look at banks, REITs, telcos, so on and so forth, we can't ignore the industrial sector as well. The industrial sector has also been going through a lot of transformation because of the shift in supply chain intensifying with all global uncertainties. The supply chain managers are also actively looking to diversify across different geographies, and of course AI and automation to increase productivity gains over there. This is one big area that has impacted our industrial sector, and because of that, investor activity in the industrial sector has picked up a lot in the past 1 year. When we look at our 100 most traded stocks on the Singapore market, 1 in 5 of them are actually industrial stocks. And this table that I have over here are the 16 most actively traded industrial stocks that have seen an increase in their turnover activity, ranging from 73%, BRC Asia traded 73% more than last year, all the way to OKP that has traded 950% more than what they did last year. OKP, maybe some of us may find them familiar, right? Okimpia, we may see some of their names. They're actually an infrastructure and civil engineering group. Their FY24, last FY, gross profit doubled. Doubled because their order book has been very strong. They also have very strong cash reserves. Order book exceeded 600 million across public and private sector. OKP, their share price actually surged over 95%. Yeah. The other one is ST Engineering, also an STI stock, also in the industrial sector. ST Engineering this year been leading the STI. You guys might have noticed share price surge quite a lot for ST Engineering. What happened over there? Not just because they are also doing more AI, automation, robotics. They have also actually announced a new dividend policy, which allows them to then share more of their returns, profits, revenue back to shareholders, and therefore the dividend payout may potentially start to grow. And that has what caused a big re-rating in this particular stock. All right? Now, today we're at ETF Festival, so we talk about ETFs. Not just about ETFs, there's also one investment strategy that I will want to talk about, which is dollar cost averaging. Very cliche, we've been talking about that for the longest time. Everyone is familiar with that. But what's interesting to note is that DCA is actually gaining traction, right? Meaning to say that for an investor, let's use the SPDR STI ETF. For an investor that has invested every month end into the STI ETF, would have gained a CAGR, which is a compounded annual growth rate of over 6.5%. Right? And we have also noticed that the ETF adoption on SGX has grown a lot. Not just retail investors, institutional investors, the adoption of ETF has grown by 150%. More and more people, institutional investors, are also allocating more into ETF. So it's not just a retail play. And that has also caused the sort of surge in this type of investing to grow significantly. And because of that, we have two STI ETFs, right? The combined AUM is more than 2.5 billion. It took us 17 years to cross the first billion, but it just took us 17 months to cross the second billion. So this is a significant sort of investment strategy over there. As you can see, retail investors in the Singapore market net bought over 16 billion worth of Singapore stocks. But from a STI ETF standpoint, it's been consistent over the last couple of years. Next one, I'll talk a little bit about S-REITs. S-REITs, something close to heart also. Again, this week, aside from STI reaching 4,000 levels, the S-REIT index has also touched the 1,030 levels. Why I point this level out, it's interesting, is because S-REITs as an index has reached this level 3 times. November last year, January this year, and also April this year, but it didn't manage to break past this level, right? And what's interesting about this sector is that the consensus estimate target price, analysts are still expecting the sector to go up by another 15%. From a financing standpoint, some analysts have also noted that the 3-month SORA for Singapore has fallen quite a lot, from 3.7% dropped to 2.1%. But on the other hand, S-REITs have yet to re-rate. So it's an interesting inflection point that we are seeing over here. We are also starting to see institutional investors, like I mentioned earlier, rotate out of banks, rotate into S-REITs. We're starting to see institutional fund inflows coming into this particular sector, right? And from a fundamental standpoint, when we look at what this sector has been doing in the last quarter, for example, the retail S-REITs posted stronger performance, rental rates going up, occupancy rates going up. From an office REIT standpoint, rental reversions are also starting to hit double-digit growth. So from a fundamental standpoint, the sector seems to be on an inflection point. What about valuations? Right? This is interesting because S-REITs today, the S-REIT index, is trading at 0.84 times price to book. This is actually a discount of 20% against the historical average. Despite, yes, it's a dampening sentiment that interest rates are still higher for longer, that has impacted S-REITs in a few ways. Financing costs, distribution yield has gone down a little bit. But because of where it's trading at the moment, with the 20% valuation, we're seeing that investors and analysts are indicating that it's a chance to perhaps reassess this sector all over again. And maybe that's the reason why we're also seeing retail investors like yourself and myself net buying this sector of over 6 billion worth since 2022. So perhaps picking up the dips, right, and riding that out. And like I mentioned earlier, the rotating out of banks into REITs is because REITs are trading at 20% discount. Banks are trading at 1.8 to 1.9 times price to book. So we're seeing that kind of rotate out of banks and go back into REITs as a trend. Correlation matrix. My point over here is that S-REITs are a good diversifier for portfolios because the correlation of how the S-REITs trade against global equities, global bonds, very low. Correlation is generally 0.4, 0.5 times. So it's on the low end, and that's why investors, even institutional investors, look at this sector as a portfolio diversifier. That's the main point for this slide. This slide's main point shows that from a balance sheet strength point, how are our REITs looking at? Our REITs are trading at a leverage ratio, means how much debt they can take on against the total assets that they have. The sector's average is at 40%. Regulatory limit is at 50%, means the sector still has a potential debt headroom to take on more debt if they need to acquire more assets. And half of the sector, half of our REITs are trading below the sector's average, so relatively healthy to weather the higher interest rate environment. This is just a quick slide from our chart book for those that's following our Telegram channel and our research newsletter. You can get this chart book from our website also. We have about 40 trusts listed on the Singapore market today. Average yield is at about 7%. We offer sort of diversified exposure into different REIT subsegments, from retail to data center to nursing homes, not just Singapore REITs, not just Singapore assets, but also global assets. For example, US data center, Japan nursing homes, we also have those in Singapore as well. But of course, for investors that do not want to do individual stock picking, that's why we're here at an ETF festival today, which is we have 5 REIT ETFs. 2 over here, Lion Philipp S-REIT ETF and the CSOP IH S-REIT ETF. These are pure Singapore REIT ETFs. You can buy the ETF and it automatically buys into a basket of individual REITs with exposure to S-REITs. We have 3 other ones that have regional focus. Those that are looking for Asia ex-Japan exposure, you have the Nikko AM Straits Trading Asia ex-Japan REIT ETF. Those that are looking for exposure for high dividend leaders, or if you're looking for Australia, Singapore, and Hong Kong exposure, there's the Philipp SGX APAC Dividend Leaders Index. Those that are looking for a bit more ESG, sustainability flavor, we also have the APAC Green REIT ETF. And last slide, today's topic is find your perfect match. In Singapore, we have 45 ETFs that range across different asset classes, from equities, fixed income, REITs, and also gold. So for those investors that are looking to find your perfect match in terms of ETF investing today, visit us. These are the ETFs that we have featured at our booth. For the Singapore market, there are 4 main ones. Top performer has been the Lion OSPL Singapore Low Carbon ETF with a flavor of Singapore domicile company with a decarbonization strategy. We also have a bunch of ETFs for income lovers, REITs, bonds, we have them also. Thematic ETFs, Hang Seng Tech, Southeast Asia Tech, Asia ex-Japan Climate Action ETF. We also have those ETFs as well, and we've got new ETFs that are coming to market very soon too. And last but not least, volatile times, we also have the gold ETF. The SPDR Gold ETF has been one of our top traded ones, also one of among the best performers. This ETF, with gold prices, it has also returned over 33% total returns across a 1-year period. So with that, hopefully it gives you a brief intro of what we're seeing from the Singapore market, trends. Hopefully that also shows you that the Singapore market is not boring. We've hit a big milestone. Is it still relevant? Yes, it's still relevant, and there are definitely options, and do check out our ETF booth later on. Thank you.